Welcome back to Bazaar. You'd have to say the market is down but not out. The bank Nifty is the one that's exerting maximum pressure, down about 1%. But the earnings season is just around the corner, so let's get you our special segment, Quarter Se Quarter Tak. We kickstart with the IT earnings that will begin next week. Reema's here to tell us what to expect. Reema.
Thanks so much for that. So even as the sector battles with worry of slowing revenue and margin uncertainty amidst the global macro deterioration, this quarter's revenue growth is expected to be steady and strong, about 3 to 4.5% revenue growth in constant currency, which is led by the strong order intake momentum seen in the prior quarters. So amongst the large cap, according to the CNBC-TV18 poll, it's Infosys which is likely to report the highest growth at 4.6% in constant currency revenue term. But as you can see over here, there is a big difference in the constant currency revenue growth and the dollar revenue growth. The constant currency revenue growth is almost 200 to 300 basis points higher than the dollar revenue growth. And that is on account of the large currency moves that we've seen in the current quarter. So while the INR depreciation on an average is about 3.5%, and it's a big positive for the Indian IT companies, look at the way the other currencies are depreciated versus the dollar, the euro, pound, Australian dollar, yen, the Canadian dollar, and this will limit the dollar revenue growth, something that we call the cross currency. So that explains why the constant currency revenue growth is expected to be higher than the dollar revenue growth. That said, the net impact of the currency moves is positive on the margins, and this is one of the factors which will drive a quarter-on-quarter improvement in margins. So let's get that poll up for you on your screen. So the highest increase is seen for TCS, where the increase on a quarter-on-quarter basis is seen at 70 basis points. But for the rest of the IT companies, the margin benefit or the margin gain is fairly limited, and that is due to the residual impact of wage hikes. So Infy this quarter gave hikes to its mid and senior employees. Wipro's wage hikes were effective 1st September, so there was a 1-month impact on the margins, while HCL Technology will also be impacted by the full quarter impact of wage hikes, which is why quarter-on-quarter there is a margin improvement, but fairly limited. Now let's move on to the FY23 guidance. Now both Infy and HCL Tech are likely to retain their annual FY23 revenue and margin guidance. So for Infy, 14 to 16% constant currency revenue growth and margins at the lower end of 21 to 23%. For HCL Tech, revenue guidance stays at 12 to 14%, while margins again will be at the lower end of the 18 to 20% band. But the key is not going to be in the numbers, it's going to be in the commentary. So far, the management commentary by the Indian IT companies has been positive in Q1 and even post Q1 in the run-up to the Q2 earnings. But most macro indicators in the developed market have been deteriorating. So the question is, will the positive management commentary hold up, or are we going to see signs of a slowdown? And in that, to assess signs of a slowdown, watch for two lead indicators of growth. One is hiring and the other one is deal wins. Both of these indicators were muted in Q1. And if you get another subpar reading on deal wins, new deal wins and hiring, this will support the bear argument on IT stocks. In terms of geographies and verticals, the affected geography is UK and Europe. So commentary on UK and Europe will be important. And also developments surrounding Credit Suisse is going to put the spotlight on BFSI. So watch for BFSI very closely, and finally retail as well, because the high inflation is hurting retail companies globally. Another question that we will be asking the management is, what about the price increases? Are customers still open to conversations surrounding price increases, or are they pushing back? And finally, as the pressures on profitability continue to mount for the IT companies, will the industry go slow on hiring? Will they resort to salary cuts or lower variable costs? Remember, in this quarter, there have been ample reports about how IT companies have given lower variable bonuses to their employees. In a nutshell, the commentary which can give you a sense of FY24 revenue and margins will be crucial. Now, the sector has already very sharply derated. This is what the COVID valuations used to look like, 30x for TCS. It's already come down by 20-25% from peak levels across the board for IT companies. But most of it is on account of a PE reset. The earnings downgrade have been fairly limited to low, mid-single digit kind. The worry is that if the slowdown accentuates, will the earnings hold up, or will we see EPS cuts? Back to you.
All right, Reema, thank you very much. Very nicely explained and very exhaustive as well. Manik Taneja is joining us, IT Services Research Analyst at JM Financial. Manik, good to have you with us here. Thank you very much. Big picture, will we get some relief, or will troubles and commentary point southward once again. What's your sense?
Thank you for having me on the show. So what we've continued to hear from companies through the course of last 6 to 7 months is that they have remained fairly confident around demand trends, while companies have had certain margin pressures to essentially deal with. I think with the upcoming quarter, and given the fact that over the course of last 3 months, we've continued to see deteriorating macro news flow, I guess we will hear some amount of caution emerging from company commentary. Over the course of last 3 months, some companies have been talking about client-specific challenges emerging, and even have been talking about uh, some sort of extended furloughs in December quarter, unlike the strength that one has seen in the last couple of years. So from that standpoint, the commentary may be a little bit negative. However, I'll also add that when you look at the commentary that one has been picking up from the global peers, and I'm talking about the likes of Accenture, Capgemini, EPAMs, Endavas of the world, most of these companies continue to suggest that the growth trajectory is sustaining above the pre-COVID levels. And in fact, surprisingly, while Indian IT companies have seen margins deteriorate, and today margins for tier one techs are running below pre-COVID levels, and Accenture improved margins last year and is talking about further improvement in margins. So global companies continue to remain much more resilient and benefiting from price increases. So from that standpoint, the commentary that we get from Indian companies as to what is the way forward will be very important.
Okay, let's take it one by one, right? Manik, what is the expectation particularly from TCS? The reason I ask is because TCS has a fairly large exposure to Europe and UK. About 30% of their revenues comes from there, and there's margin pressure expected as well. What is your own thought, and how would you approach the stock now ahead of the earnings?
Sure. So we've had a hold rating on TCS, and in case of TCS, we've seen that TCS has underperformed peers like Infosys on growth through the course of last 3 years, and I think that story will stay intact even through the next few quarters. Certainly, with their higher exposure to Europe and UK, and which is basically both translating into significant cross currency headwinds on reported dollar terms, and also translating into margin headwinds given the fact that INR is appreciated against GBP and Euro. So from that standpoint, TCS is expected to have a relatively weak uh, revenue growth performance as compared to somebody like Infosys. Uh, in terms of so what we will be looking for when TCS reports is what do they suggest on the order booking numbers, and how are they seeing their large European customers essentially behave in terms of spending trends going forward.
Okay, hi Manik. I was just looking at the chart that Rima put up, and HCL Tech has always traded a bit of a discount in comparison to its larger peers. But, doesn't it make it a bit of a compelling argument on the buy side? What's your view? HCL Tech, Tech Mahindra, they're trading even at a discount in comparison to the last couple of years' averages. What's your view?
Sure. So certainly, if one looks at the current valuation multiples relative to pre-COVID multiples, the premium for an HCL Tech or Tech Mahindra may be much lesser as compared to an Infosys or a TCS there. Now, both these companies have their own set of challenges. Tech Mahindra, the name that you mentioned, their margins are already back to an 11% levels. So that's a company which typically tends to improve margins to about 15%, closer to 15% in the span of 2 years, and then takes 2 quarters to get back to 11% levels. So that's the volatility that is associated with Tech Mahindra. In case of HCL Tech, their services business has kept on doing quite well, but the product business has had a very tepid revenue growth, and there are concerns around the sustainability of the product business. And even HCL Tech has compromised on margins over the course of last 12 months. That said, in case of HCL Tech, what we are enthused with is the way they have been doing well in terms of order bookings over the last 12 to 18 months time frame, and the fact that now their growth mix essentially is far more balanced as compared to infra-driven growth for them in the past.
Okay, just one final question then. Do you expect both Infosys and HCL Tech to retain their growth outlook for FY23, or do you think that some of these companies may scale it down as well, given the challenges?
So, given the way arithmetics is, I see very little risk to Infosys pulling down their revenue growth guidance. Probably the arithmetics is slightly more tougher for HCL Tech from a relative standpoint. In terms of margins, both these companies after 1Q itself guided for margins to trend closer to the lower end. And I would presume that they will probably stick to that outlook even with this quarter's results.
All right, Manik, thanks very much. Good speaking with you. Appreciate you joining in with that perspective. It's always a pleasure, and hope to catch up with you once we have the full set of results. Well, the market is swinging widely, isn't it? I mean, we were down 20, then down 80, and down 20 again. So that impulse to try and buy the dip is very much evident. It's there on your screen, back above 17,300 once again. And overall market breadth, just even if you can have the advanced decline, that is flipped again. I mean, there are, when last time I checked, 15 minutes back, 300, 400 stocks outpaced declines more than advances. And look at the crisscross which is playing out. So it's a pretty choppy kind of sort of day, not just on the Nifty, but for the broader market as well, which we are continuing to track. But Sonia, I mean, the big talking point, of course, has been festive-related consumption. And I think we've got a stock check ahead.
Absolutely, and this time around, I think after COVID, a lot of us have gotten used to doing our festive shopping online, right, compared to offline. So that is the big focus area this time around. We are going to look at how retail trends are shaping up. But a report by Redseer has said that e-commerce gross merchandise value for the week ended September is up 27% versus last year. And the number of shoppers and the average spending has also clocked in a significant rise online. So to discuss the trends both in the offline and online world, we're joined now by Kumar Rajgopalan, the CEO at Retailers Association of India, and Tarun Pathak, who's the Research Director at Counterpoint. Gentlemen, morning to both of you. Mr. Rajgopalan, I want to first start with you. Has the consumer preference changed post-COVID? Are you seeing more online sales, and hence, is it eating into the offline channel?
Good morning and season's greetings to all of you. I think this is the first year after 2 years that everybody is out there shopping, feeling the sense of cheer. So I would not say that things have shifted dramatically. Fact is that consumers are thinking differently now. They want to think about what they want to buy. They want to think about how do they get it. There is a sense of immediacy, and then there is a sense of discounts. And there is also this need for making sure that they trust the person who is selling to them. So I think that's a complex set of things that's happening. The online sales is increasing, but I think the offline sales is also rocking currently. We've seen that East, which is normally the indicator for the way business grows, has clocked very well. They have shown 25% growth already, and I'm expecting the latest results to come in. So things should be nice there. And normally what happens in the East is reflected in the other parts of the country because Pujo shopping happens first there, and then the Diwali and the other things start here, rest of the country. So shopping is expected to be good. The kind of items that were worrisome during the pandemic are doing now very well. So if you look at garments, if you look at wearable accessories, jewelry, eating out, all this is doing really well. Beauty and cosmetics is doing very well also because people are wanting to go out, meet people. They are buying more beauty products. Also, people from abroad are coming in and buying here. So it's been a good part. For many retailers, of course, it's an omni-channel world. So they're not really bothered whether people are buying online or offline. But one thing is for sure, there is a sense of parity that's happening between offline and online in the way in which offers are being given, or for that matter, service levels are being accorded to the customers.
As you said, things are rocking. Market has come back into the green. Mr. Rajagopalan, just have the Nifty up, please. We are in the green. And we're the day's highest point as well, 17,334. Look at that. I mean, it's a sharp, sharp recovery we've seen. And I think we've got the Bank Nifty, which has also cut its losses. I mean, that's basically, Bank Nifty is at the day's high. It's down 0.6%, but it's come back almost to the day's highest point. Maybe just a quick look at the Nifty IT space as well, which is flipped into the green. It's up about 0.2% or so. So that impulse to buy the dip very much there, and that's showing up Can we do a lot today? That remains to be seen, given the fact that later in the US we have that jobs number, which I think will, at least in the very near term, decide the fate for global markets. Nigel.
All right. Let's get back to the discussion that we were having. Let's get in Tarun Pathak, Research Director at Counterpoint, who joins in. Hi, Tarun. Morning. Thanks so much for joining in. All right. Okay. All right. Let's get back to Mr. Rajagopalan.
Maybe he's gone shopping online. You never know, right? Taking some time, a bit of a time off. Okay.
All right, Mr. Rajagopalan, you were saying that the festive season is expected to be a good bounce back. Now, you had to put a number to it. After 2 years, we're going to be seeing a normal Diwali. How much better can it be in comparison to the pre-COVID level? What's your sense?
I think your criterion by itself is right. We should always compare it with the pre-COVID levels because the last 2 years were haphazard, if I could call it that. So already from April up to August, the overall retail industry has grown about 19% across the country, which is good compared to the 2019-20 levels. Our expectation is that it should go beyond this. Ideally, it should be about 25%, which is what we've seen in the East so far. Yeah, that would be a good number to look at. We do know that there's an inbuilt amount of inflation up there, which we'll need to be aware of. But the fact is that customers are spending from their pockets. So at the end of the day, the money from their pocket is important. Various things are happening for it. I think, like I said, there is cheer overall. The people are going out. People are also gifting. And that's the other good thing that's happening this time. And of course, people are buying omni-channel.
Right. Okay. By the way, Mr. Rajagopalan, we'll come back to you. We had a retailer like V-Mart, right? I was reading in an interview, the CEO of V-Mart was saying that a festive cheer has arrived, but not for everyone. And V-Mart is a tier 2, tier 3 operator, right? So that's a telling comment as well. But anyway, Tarun Pathak is with us. Tarun, sorry, we coming to you a little late. We didn't have you earlier. On mobile phones, Tarun, what's happening? Yeah. What we've observed is in mobile phones as well, the push to premiumization, isn't it?
Yeah, that's very important point you have mentioned. Very good morning to everyone and season greetings. I think that is right. There is a premiumization trend that has set up in India. People are buying mid to high-end phones, and that is driving the value of the overall category. So what we have seen, the premium market is, which we define as more than 30,000 rupees, that contributes to 10% of the overall smartphone sales. And now this number is going to increase by 2 or 3%. People are upgrading fast, and that has been one of the biggest trend this year in the festive season. First day of the festive season sale was all about iPhones. People were crazy buying iPhone 13, iPhone 14 in that sense. So we have seen across both in offline and online channels, there is a lot of demand that is coming from the mid to premium hand phones. And that is also because of the reason you have a lot of financial schemes that have come in as compared to the last year or last to last year, like BNPL, buy now, pay later, credit card schemes, financing schemes are here. And people want to get future ready. Like, for example, we are at the cusp of technology transition, which means everyone is going to buy a future-proof device, which is a 5G phone. And if you look at the average cost of a 5G phone, that is somewhere closer to a good 5G phone, is somewhere closer to 23,000, 24,000. If you have to buy a good 5G phone, of course, you can buy it the higher as well. And that is also driving a lot of people to shift from a 4G phones to 5G phones in the country.
Okay, people are buying more phones, and first day you've seen a surge in iPhone sales. I mean, forget about all the normal phones. It's so premiumization definitely is the name of the game. Gentlemen, we'll have to leave it at that. Unfortunately, we've run out of time, but thanks a lot for your thoughts. That's the word coming in on how e-commerce sales and actually festive sales have been shaping up. We'll slip into a quick break. On the other side of the break, we'll get cracking back on the market. Shrikant Chauhan will be joining in for some technical trades. Stay tuned.
Welcome back. 25 lower now, so very tight range, but things are extremely choppy from the word go today. We came back into the green, up by almost 10-15 points, and there is a bit of a drop which has happened once again. Shrikant Chauhan is with us. Shrikant, I mean, are we going to be in this sort of holding pattern kind of structure, or you think today itself we may see some moves? Later out of the US, you have an important data point. US markets were also slightly lower. And one can't say we've had big moves post this data point. I'm talking about the jobs number. What would you recommend?
Yeah. See, Prashant, the markets are in the crucial zone. It is not falling below the levels of 17,000. It is not crossing the levels of 17,800. So till then, we are going to see highly volatile markets. And in the short term, now we are again into the specific range. So for the day, based on the data which are going to come in the US today, what we need is that we need at least a close above the levels of 17,350. Above that, then we can expect further more activity in the market, and in that case, the chances of hitting 17,700 or 800 would turn bright. On the downside, the important level is 17,180. So below that, if we see the market is closing, then we can expect further more weakness. So what is important is 17,180 and 17,350 on the higher side. For the day also, it is important for the market because see, in the morning we were expecting that the market should bounce back from the lower levels, from where we saw a nice bounce back or pullback. But now the important part is that whether the market sustains above the levels of 17,350 or not. And for that, we need support from either financials or IT. Today, financials are a little bit down, but in the second half, if we see any come up in the overall financial space, then we can expect further more sustenance.
Okay. Any individual stocks that you want to look at? I know today is a very tricky market because, you know, you may not want to leave your positions open considering the big event later in the evening. But any stocks you're looking at?
See, Sonia, broader space is really doing well, and number of consumption-related stocks or festival-related stocks, they are doing really well. In that, we like shopper stock, which is around some 750, 745. There we feel that the stock is consolidating, but the overall trend of the stock is of rising top, rising bottom, which clearly indicating us that it is heading for the levels of at least 850, 900 in the long run. But in the short term, again, we can see the levels of 800, 820. So it's a buy at current levels with a stop loss at 725. And the other stock which we like is from the sugar space, and all the stocks from the sugar space, they are doing really well. In that, Renuka Sugar is doing well, and it has broken its important horizontal resistance at 63. So above 63, the next level to watch out for would be 68 or 69. So it's a classic technical breakout. It's a buy at current level with a stop loss at 61.
Okay, all right. Thanks a lot for that. So that's some ideas coming through on individual stocks. But let's shift focus to the commodity markets now. Manisha is back with us. Manisha, is it still crude that you're tracking or anything else?
Well, I'm looking at crude clearly, but I'm looking at silver as well because we're looking at very strong gains into this one in this week as well. We're trading at a 3-month highs and the prices have gained up by 8% in this week. When you look at the international range, we've traded between $18 on the lower side to nearly $27 per ounce on the higher side. In the Indian markets, the current year range has been from 51,000 to 73,000 and we're trading at around 61,000 right now. The highest that you have seen in case of silver prices ever has been at around 79,000 rupees per kg, and we did come close to those kind of levels in this year. It has been a very volatile year when you look at that in case of silver there, but the markets will keep an eye also on the fundamentals here, where you are looking at the physical buying being on the stronger side, not so much in case of investment buying, but the physical buying in Asian markets, in Europe, in Middle East has been quite strong when you look at silver. For the Indian markets, though, the numbers are even better. If you look at the COMEX warehouse inventories, they are at just about 313 million ounce, which actually is the lowest since June 2020. Also, when you look at the LBMA vault holdings, those are at around 28,000 tons, which is the lowest since July 2016 as well. So inventories, mine supplies in case of silver have been on the weaker side there. For India, though, the imports that we are looking at are the third highest on record at around 6,200 tons of silver import is what we've done in this year already until now. All-time high number was in 2015 at 7,530 tons. So a very strong silver buying, whether it's about industrial demand, gifting, rural buying, all of that really seems to be picking up for a second straight year into this one. This is what we've done in sense of Indian imports, and as you can see, it has been a rising year after year. 2020 was COVID year, and the last year as well saw lesser imports. But this year, as you can see, we are looking at a stronger number there. The next chart that comes on your screen is about the global supply and demand numbers. That tells you that we are looking at a deficit for a second straight year this time around. 2021 was a deficit year, first time after 2015, after 6 years of enough supplies into the market. But as you can see, last year demand was higher, and this year the demand is expected even higher, so much so that the Silver Institute says that you could be looking at record silver demand for 2022 this time around. When you look at the deficit numbers, Silver Institute expects deficit at around 2,024 tons. Metal Focus is estimating it at 71.5 million tons versus 51.8 million ounces of a deficit in the previous year as well.
Okay, thanks a lot for that, Manisha. Let's move from the from commodities to currencies. The big talking point this morning really is the record low that the rupee has opened at 82.20, and that's a steep fall in just one trading session. Lata is here to tell us the factors impacting the rupee. Lata, over to you.
Well, it has fallen 1% over the past 2 days, and that's because of the double whammy. It's both crude prices and dollar strength. You don't normally have the two coming together because dollar strength means commodities are priced lower. But now, for idiosyncratic reasons, both are higher. And the rupee has underperformed Asian currencies. One of those rare occasions in 2022 because India is a little more vulnerable to crude than any of the other Asian currencies. So a slightly higher depreciation. Dealers tell us that there has been very big buying in dollars by oil companies. The other segment which is apparently buying dollars is those who went short on the dollar, anticipating that India will be included in the bond index and there will be a lot of dollar flows. Those guys also may be covering positions now as you realize that the level is going above 82. The Reserve Bank, what is it doing? Dealers tell us that over the past 2 days, they're offering dollars. But either because the demand is strong or because they don't want to change the trend when it is global, they're just offering. They're not trying to actually determine the level of the exchange rate. In fact, from a Reserve Bank angle, a gentle depreciation is welcome because at least with China, the trade deficit is very high. There was a recent Citi report saying that, part of it is because Indians are buying more consumer goods. A good Indian GDP actually is leading to higher consumer imports, and they invariably tend to be from China. But part of it is also because the rupee has depreciated more vis-a-vis the yuan, and therefore perhaps appreciated more versus the yuan, and therefore depreciation is welcome. The market, of course, watches round numbers, so now they're watching for 82.5. And then they will start watching at 83, whether the Reserve Bank is protecting those levels. Just a word on bonds. Bond yields are also rising and affected by the same factors. A rupee depreciation, higher crude prices, non-inclusion in the bond index, and of course, US yields are also rising. So, there is a bit of negative macros when it comes to the yields. On rupee, I won't call it negative. A rupee depreciation is Indian corporate positive. So not to worry too much about that. It's a gentle one. With that, we'll take a break. And thereafter, we go over to our special segment, It's the Economy. We are going to look at the economy from the prism of the real estate sector. And to take us through that discussion will be Abhishek Ludha, Managing Director and CEO of Macro Tech Developers. The company reported a record quarterly sales just a couple of days back. We're going to look at the real estate sector and the economy with Abhishek Ludha in a minute.